Mr. AG here. Silver investment demand is about to surge 20%. Bar and coin purchases are climbing to 227 million ounces in 2026 as Western buyers flood back into the market alongside sustained appetite from India. And this is not speculation. This is data from the latest industry projections. 227 million ounces of physical silver that buyers want to take off the market and put into their hands. And here's the problem. The silver market is already running a structural supply deficit for the 6th consecutive year, 6 straight years where demand has exceeded supply. The projected deficit for 2026 is 67 million ounces, and that is with total mine output reaching a decade high. Let me say that again. Miners are producing the most silver they have produced in 10 years, and the deficit is still 67 million ounces. Production is at a decade high, and it is still not enough. That single fact should be on the front page of every financial publication in the world, and yet most people watching mainstream media have never heard it. That is why this channel exists. Before I go any further, I want to hear from you right now. Drop Mr. AG in the comments and tell me where you are watching from. Are you in the US? Are you in Canada? Are you watching from India where physical silver demand has been relentless? Are you in the UK, Australia, Singapore, the Philippines, Japan, anywhere in Asia? Drop your location because this is a global story and your local perspective matters. What are you seeing at your local bullion dealer? Are premiums rising? Is inventory available? Tell me in the comments. Let us build this picture together. Now let me be absolutely clear about something for everyone, especially the new people finding this channel. I do not sell signals. I do not sell courses. I do not run paid memberships. I do not sell anything. If someone contacts you claiming to be me or claiming to represent Mr. AG and tries to sell you anything, block them immediately. That is not me. I will never ask you for money. I'm only on YouTube and X. My handle on both is Mr. AG Asian Guy. That is the only way you know it is really me. I share the raw picture here, both sides, the bullish case and the bearish case, the data, the context, the connections. So many of you have messaged me saying this content helps you understand what is really happening and make better decisions. That means everything. That is why I do this. Now let me walk you through the full picture because these numbers are staggering when you connect them all together. Global ETP holdings for silver have reached an estimated 1.31 billion ounces. Lease rates in London have climbed to all-time highs. When lease rates hit all-time highs, that tells you physical metal is becoming increasingly difficult and expensive to borrow. The market is tight. Not theoretically tight, measurably tight. The cost of borrowing physical silver in London, the center of the global precious metals market, has never been higher than it is right now. That is not an opinion. That is a data point that you can verify. Industrial demand remains anchored near 650 million ounces annually. Now there is a nuance here that I need to walk you through because the composition of that industrial demand is shifting and the shift matters. Solar panel consumption has pulled back somewhat, but that pullback has been offset by surging requirements from 2 areas that are only going to grow: AI data centers and the automotive sector. Every AI data center being built requires silver in its electronic components, its connectors, its circuitry. Every electric vehicle rolling off the line requires more silver than a conventional car. The demand is not disappearing. It is migrating from one structural growth sector to other structural growth sectors. The net result is 650 million ounces of industrial demand that is not going away. And here is where the mining data makes the supply side of this equation truly alarming. The biggest silver miners on the planet just posted the best financial results in their histories. Record revenues, record production, record cash flows, and the deficit still got worse. Let me walk you through the numbers because these are extraordinary. Pan American Silver generated $3.6 billion in annual revenue, $554 million in operating cash flow in the 4th quarter alone. Silver production of 22.8 million ounces exceeded guidance. Free cash flow hit $1.15 billion for the year. They raised their dividend 29%. Their CEO said they expect another strong year of cash flow generation in 2026, with silver production forecast to climb approximately 14%, driven by increasing output from the Juanicipio mine. They are sitting on $1.3 billion in cash and short-term investments. This is a company firing on all cylinders, producing at record levels, and it is not enough to close the deficit. Coeur Mining nearly doubled revenue to $2.1 billion. Net income increased more than tenfold to $586 million. Silver production surged 57% year over year to 17.9 million ounces. Free cash flow reached $66 million. They achieved net cash status by year-end with $554 million on hand. Production guidance for 2026 calls for 18.2 to 21.3 million ounces of silver. Rochester Mine posting record, or crushing and placement rates. Another company delivering historic results, and still the deficit persists. First, Majestic Silver set records with 15.4 million ounces of silver, an 84% year-over-year increase. Fourth quarter output alone jumped 77% to 4.2 million ounces. Record quarterly revenue of $463.9 million in Q4, with silver sales accounting for 60% of total revenue. Their CEO called 2025 truly a transformational year. They have tied their dividend directly to net revenues, giving shareholders direct leverage to rising silver prices. And still, the deficit persists. Endeavour Silver produced 6.49 million ounces of silver and 37,164 ounces of gold, bringing combined silver equivalent output to 11.2 million ounces. Terronera mine ramping up after commercial production declared in October. Higher grade zones expected in the second half of 2026. Add all of this together. These are some of the largest silver producers on the planet. They are all producing at or near record levels. They are all generating record revenues and cash flows. The mining industry is doing everything it can. And the structural deficit is 67 million ounces. 6 consecutive years of deficit. That is the supply side reality. Now let me give you both scenarios because I always give you both sides. Bearish case first. A 20% surge in investment demand sounds bullish, but it also means prices have already moved significantly higher to attract that demand. Some of that demand could be late money chasing performance rather than smart money positioning ahead of a move. If silver prices pull back sharply, some of those new Western buyers could panic and sell, creating a wave of liquidation in the physical market. The deficit of 67 million ounces sounds dramatic, but it is being met by drawing down above ground inventories and ETP holdings. As long as those inventories exist, the deficit can persist without causing a supply crisis. It is a slow drain, not an immediate emergency. Industrial demand could weaken if global economic conditions deteriorate. PMI data from major economies has shown contraction signals. If manufacturing slows significantly, the 650 million ounce industrial demand anchor could slip lower. A stronger US dollar or higher for longer interest rates could pressure the spot price regardless of physical fundamentals. Paper markets respond to macro forces in the short term, and those forces can overwhelm physical tightness for extended periods. Mining production hitting a decade high means more supply is coming online. If prices stay elevated, new projects become economical. The supply response could accelerate in coming years, even if it takes time. That is the bearish case, and it deserves honest consideration. Bullish case. 6 consecutive years of deficit is not a temporary dislocation. It is a structural condition. Above ground inventories are finite. Every year the deficit persists, those inventories shrink. At some point, the buffer runs out and the market faces a genuine physical supply crisis. London lease rates at all-time highs are the early warning signal of exactly that process. The 20% surge in investment demand is coming from Western buyers re-entering the market. This is significant because Western investment demand has been subdued for years. If Western capital joins Indian and Asian demand simultaneously, the deficit widens dramatically. London lease rates at all-time highs confirm physical tightness that is intensifying, not easing. This is not a theoretical tightness. It is showing up in the actual cost of borrowing metal. When it becomes more expensive to borrow silver than at any point in history, the supply chain is telling you something important. The mining industry is producing at decade highs and posting record results, and it is still not enough. There is no quick supply fix. New mines take 7 to 15 years from discovery to production. Even with record output, the deficit is 67 million ounces. What happens when industrial demand from AI and automotive accelerates further while mine supply plateaus? The math becomes inescapable. Central banks continue buying gold at historically elevated levels, reinforcing the broader precious metals thesis. Silver historically outperforms gold during the latter stages of bull markets as the gold to silver ratio compresses. If we are entering that phase, silver's upside is multiples of what gold delivers from here. And here is the question that I keep coming back to. If the biggest silver miners in the world are producing at record levels, generating record revenues, posting record cash flows, raising dividends, sitting on billions in cash, and the supply deficit is still 67 million ounces in its 6th consecutive year, what exactly resolves this deficit? More mining? Production is already at a decade high. Less demand? Industrial demand is anchored at 650 million ounces and growing from AI and automotive. Less investment demand? It is surging 20%. Something has to give. Either prices rise high enough to destroy demand, which historically requires a massive move in silver, or the physical market eventually seizes up when the inventory buffer is exhausted. Those are the 2 mathematical outcomes. There is no third option, where deficits persist forever with no consequences. About 70% of you watching right now are not subscribed. If this kind of raw, data-driven, both sides analysis is helping you cut through the noise and understand what is actually happening in the silver market, then hit subscribe. That is how we grow this community. Not through hype, not through selling you anything, through substance. If you want real-time updates and direct discussion, join our WhatsApp community. Link is in the description. Follow us on X at Mr. AG Asian Guy for breaking alerts and quick analysis. 3 key takeaways. Number 1. Silver investment demand surging 20% in 2026. Bar and coin purchases climbing to 227 million ounces. Western buyers re-entering alongside sustained Indian demand. Global ETP holdings at 1.31 billion ounces. London lease rates at all-time highs. The physical market is tightening in ways that are now measurable and undeniable. This demand surge is landing on top of a 6th consecutive year of structural supply deficit projected at 67 million ounces. Number 2. The biggest silver miners on the planet just posted record results across every metric. Pan American Silver 3.6 billion revenue. Coeur Mining doubled revenue to 2.1 billion. First Majestic surged 84% in production. Endeavor Silver ramping Terronera, mine output at a decade high, and the deficit is still 67 million ounces. The mining industry is doing everything it can, and it is mathematically insufficient to meet demand. There is no quick supply response. New mines take years to develop. The deficit is structural, not cyclical. Number 3, industrial demand anchored at 650 million ounces with AI data centers and automotive replacing some solar pullback. The demand composition is shifting, but the total is holding firm and growing from sectors that are in the early stages of multi-decade buildouts. When you combine surging investment demand, record but insufficient mine supply, all-time high lease rates, and 650 million ounces of sticky industrial demand, the structural case for significantly higher silver prices is the strongest it has been in modern history. The only question is timing. Short-term forces can delay the repricing, but they cannot prevent it. 6 years of deficits and counting. The math is the math. Drop Mr. AG in the comments. Tell me where you are watching from. Tell me what you think resolves a 6-year supply deficit when production is already at decade highs. I want to hear your perspective. Share this with someone who needs to see the actual data, not the mainstream version. Join the WhatsApp community, link in the description. Follow us on X at Mr. AG Asian Guy. Do your own due diligence. Understand the risks, have a plan, know your timeframes, use your brain. Do not follow anyone blindly, including me. But understand the data, because the data right now is speaking louder than it has in years. Stay sharp. Mr. AG out.